So let's look at Uber's third quarter 2020 expected earnings. Gross bookings, 14.49 billion expected versus 16.5 billion in quarter three of 2019. The rides gross bookings, which is down at least 50%, 6.44 billion expected versus 12.55 billion in quarter three 2019. The Eats gross bookings looking healthy, 7.8 billion expected versus 3.65 billion in quarter three 2019. So Uber will report its Q3 earnings after the closing bell on Thursday, coming up right now. The announcement follows an election day victory for the company with the passage of California's Proposition 22, a measure that exempts it along with rival Lyft and businesses like Instacart and Grubhub from having to treat drivers like employees. Still, the impact of the ongoing coronavirus pandemic continues to be a concern for Uber's main rides business, while conversely serving as a boon for its Eats arm, which saw a massive 113% year-over-year increase in bookings last quarter. Here's what analysts are expecting from the company in the quarter as compiled by Bloomberg, compared with how the firm performed in the same quarter last year. As I've read you these, gross bookings, 14.49 billion expected versus 16.5 billion in Q3 2019. Rides gross bookings, 6.44 billion expected versus 12.55 billion in quarter three 2019. Eats gross bookings, 7.8 billion expected versus 3.65 billion in Q3 2019. Losses per share, 61 cents expected versus $1.02 in Q3 2019. Uber's ride-sharing model has been dramatically impacted by the pandemic, with rider totals plummeting due to a lack of available entertainment options ranging from movie theaters and bars to ball games. Exasperating the problem is a lack of business travelers who would normally look to Uber as an alternative to using a black car or yellow car service. In Q2, Uber reported a 1.8 billion loss after its Rise business collapsed by a stunning 74% year over year. In May, the company filed paperwork with the SEC indicating that it was to cut roughly 14% of its workers, or 3,700 jobs, primarily in its customer support and recruiting divisions. And while there are signs of returning growth, a steady increase of coronavirus cases across the United States and Europe, and could further hinder Uber's efforts to return to its pre-COVID ridership levels. Also want to add to this, what they're not taking into consideration here, is a lot of the people that did rely on Uber and Lyft have moved on. Car sales, they've turned to car sales, right? Interest rates are at its lowest. They've committed to buying new cars. Car sales have gone through the roof during the pandemic. So that's not taken into consideration. They're sort of under the impression that ridership's going to come back. I would say the majority of the ridership is gone. Still, Wedbush analyst Dan Ives wrote in a research note that he is seeing positive movement in Uber's direction, especially as consumers feel less comfortable taking mass transit during the pandemic. The overall environment is starting to considerably improve for Uber over the coming quarters, with 2Q marking a clear trough in volumes and fundamentals, in our opinion, he wrote. We also believe a consumer dynamic that is becoming commonplace across cities, both in the United States and internationally, is many steering clear of mass transportation given health concerns and lack of comfort taking subways, buses, and this could be an incremental demand driver for ride-sharing vendors over the next few quarters at least. Outside of the pandemic, Uber and its investors received welcome news in the form of the passage of Proposition 22, the measure which was approved by 58% of California voters. Without a win, Uber and Lyft threatened to pull out of the California entirely, The firms have made similar moves in the past, most notably in Austin, Texas, which they left in 2016 after the city passed a measure calling for stricter background checks and fingerprinting for drivers. A year later, however, the Texas state legislature overruled Austin and Uber and Lyft returned to the city. Whether the firms would have actually delivered on their threat to leave California, the world's fifth largest economy and a major market for ride-sharing service, will remain an unanswered question. That was absolute BS. I saw that as the biggest bluff. They would have never abandoned their number one market. Your thoughts, please. We are giving our sponsor here, Kover, Kover, a shout out. Starts at $7 a month. Services all of these gig companies. What is it? It's a gig protection plan. You can play around with the dashboard a little bit. You have your auto insurance, you have your medical insurance, and go and get yourself a gig protection plan. If something goes wrong, God forbid, I hope not, but then at least you are protected. If your car's in the workshop, if you end up in the hospital, Kover kicks in, right? If you get wrongfully deactivated because of some false report, their partner, legalrideshare.com in Chicago, they kick in. Kover has retained Legal Rideshare to write letters for its members demanding that gig companies promptly reactivate their account if they have been wrongfully terminated. Other phenomenal services that legalrideshare.com in Chicago offers: if you get injured, major injury, if your car is in an accident, your car is totaled, complete write-off, or if you are out of commission for a while and you have lost wages due to an injury, Legal Rideshare will file your insurance claim, handle your insurance claim, and go after the insurance company and get you the money. And that, again, is for injury, property damage, and wage losses. I would really like to hear your comments about the Q3 earnings. Should be out shortly. What do you think?